Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
How do you then work with clients to factor this resilience around inflation into portfolios? Do you think that the traditional asset classes are still sufficiently participating in inflation like that?
Well, the challenge with inflation as a concept is that it is really hard to predict. It's this multi-layered concept that just works its way through the system. But similarly, for asset allocators, it's really hard to protect themselves against inflation. So our argument would be that diversification would allow you to increase the resilience of portfolios. So this is something that we are arguing for, especially in the current context where there is genuine vulnerability there in concentration of portfolios, be it the US dollar, US equities, the technology companies within the US equities. So talking about diversification through various asset classes is already a benefit. But then considering the main area of activity for IFM, which is infrastructure investing, I find myself often speaking about the benefits that infrastructure, especially core infrastructure, could bring to the portfolios, because these are assets where the link to inflation is more direct than you could find in any other asset classes that traditionally are known as protection for inflation. So, for example, toll roads or utilities, they would often have direct escalation to inflation. So that is really helpful for clients. And I see it in the market that there is so much interest from institutional investors in core infrastructure. So it's the signal that despite this level of complacency exhibited in the current pricing of different assets, there is still the realization and certain level of constructive anxiety in the institutional investor